Many Vanguard fund investors will earn even more money starting this month. Hello, members, super savers, and bond course fans. I hope you're healthy and well. So on Monday, February 3rd, Vanguard announced that it would reduce its already low fees even further on quite a few of its funds, meaning that your return as an investor on those funds will be a bit higher going forward. Because remember, fund expenses are deducted from a fund's earned income before that income goes to investors. So lower fees means less expenses for the fund and more money in your pocket. With that in mind, here are the 3 topics that we'll be covering in today's video. 1. Why is low-cost investing so important? And how much of a fee cut has Vanguard just announced? 2. Why is Vanguard doing this? More specifically, are they in trouble, and will this expense ratio reduction compromise their customer service and overall standards? And 3, which Vanguard funds might you want to have a fresh look at now that they're even cheaper? And in this section, we'll also talk about a highly popular Vanguard fund that you can actually find cheaper elsewhere. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why is low-cost investing so important? And how much of a fee cut has Vanguard just announced? Now, Vanguard and its founder, John Bogle, have long been proponents of low-cost, long-term diversified investing. Vanguard founder John C. Bogle explained why investment costs matter this way. In investing, realize that you get what you don't pay for. Whatever future returns the markets are generous enough to deliver, few investors will succeed in capturing 100% of those returns, simply because of the high cost of investing. All those commissions, management fees, investment expenses, yes, even taxes. So pare them to the bone. The emphasis on low-cost investing for all of us is because lower-cost portfolios tend to outperform higher-cost ones. Vanguard believes that their fund's impressive long-term performance owes much to the low cost. For the 10 years ended December 31st, 2024, 84% of Vanguard's funds outpaced the average results of competing funds. The performance of Vanguard's actively managed fixed income funds has been especially strong. 91% of Vanguard's active bond funds and 100% of their money market funds have outpaced their peers' average results. Vanguard turns 50 on May 1st, so this biggest expense ratio reduction in their history seems to be well timed. Here's an overview of the fee cuts that Vanguard just announced. 1. Vanguard will reduce fees on 168 share classes across 87 funds. 2. The fee reductions are expected to save investors more than $350 million in 2025 alone. 3. These reductions will go into effect retroactively per February 1st. As we mentioned earlier, retroactive should be music to the ears of Vanguard investors in this case. So far, so good. But just to manage expectations, Vanguard is already known for its low fees, as we just discussed, and as many of our Diamond Nest Egg regulars know from various videos on this channel. In fact, Salim Ramji, Vanguard's new CEO, stressed in a short interview on their website, since 1975, we've actually reduced our fund's expense ratios more than 2,000 times. Vanguard states that overall 86% of Vanguard mutual fund and ETF assets are in the lowest cost deciles of their peer groups. So there's only so much remaining fat that can be cut, so to speak. For the funds in question, most fees will be reduced by between 1 and 6 basis points. So maybe not that much in absolute terms, but this can still be a significant reduction percentage-wise and in relative terms. As I always say, every penny counts in the world of finance, both for us as investors and for Vanguard as a firm, which brings us nicely to the next section of today's video. Why is Vanguard doing this? In the interview I mentioned earlier, CEO Ramji claims that there will be no false compromises, but that at Vanguard, you'll continue to get both great performance, high quality basically, and low costs. According to his words, there's a false dichotomy between do you want great performance or high quality, or do you want low costs? At Vanguard, you can get both. In our opinion, there are 3 likely reasons why Vanguard is cutting its already low expense ratios even more. Reason 1. Vanguard had some not so good publicity around their introduction of new fees last year, as we discussed in this previous Vanguard update video, link below for easy reference. So these lower expense ratios that they've just announced may be a way of counterbalancing last year's fee increases. Reason 2, new CEO Ramji's primary mandate probably has to do with re-energizing both growth and profitability at Vanguard. As some of our Diamond Nest Egg regulars may recall, in this same Vanguard update video, we talked quite a bit about new CEO Ramji because it surprised many in the industry. As a former senior executive at BlackRock, Ramji is the first outsider ever to take the helm of Vanguard. Ramji has more than 25 years of experience in investments, capital markets, and wealth management, and at BlackRock was most recently global head of iShares and index investing, where he was responsible for managing a majority of the firm's client assets and evolving the iShares platform to provide an even broader set of innovative low-cost products for investors globally. As we said in our Vanguard update video, Vanguard's management shakeup in 2024 and the installation of Ramji, who surely must have played a critical role in BlackRock's pole position amongst the world's largest asset managers, was probably one of Vanguard's first steps in tackling their lagging revenue and growth positions relative to this peer group. Competitors like BlackRock, Fidelity, and Schwab seem to have been a bit more dynamic over the past few years than Vanguard. So reason 2 for lowering expense ratios should come as no surprise. And reason 3, Vanguard is probably not averse to getting a bit of good publicity and sharpening their profile at the beginning of a new year. A new year also means new goals for many of us in our private lives, and especially when it comes to our money. This isn't much different in the world of business. So, in our mind, these are all legitimate corporate reasons that do not raise any red flags so long as what you're after is low-cost funds and don't care for bells and whistles. Because let's face it, while the goal to save investors more than $350 million in this year alone is a noble and impressive goal, this $350 million that will now flow into investors' pockets will also likely mean $350 million less for technology upgrades and customer service at Vanguard, at least at the beginning. Of course, if the fee reductions succeed in reinvigorating the business and Vanguard starts pumping up the sales volume, so to speak, they may make back the $350 million or even more perhaps that they may be able to use for investing into their platform. But be that as it may, I know that many of the Vanguard fans in our community are Vanguard fans because they care less about the bells and whistles and sometimes don't mind so much about a less proactive customer service as long as Vanguard's funds remain low cost and high performance, which is a great segue into the next section of today's video. Which Vanguard funds might you want to have a fresh look at now that they're even cheaper? So let's start off with the 5 largest Vanguard share classes with reduced fees for bond and short-term reserve funds, meaning money market funds. These are their Bond Market Index Fund, VBTLX, their Treasury Money Market Fund, VUSXX, their Intermediate Term Corporate Bond ETF, VCIT, their Short-Term Investment Grade Fund, VFSUX, and their tax-exempt bond ETF, VTEB. In this column, you have the prior expense ratio for each fund, and in this column, you have the new expense ratio. And because I know you'll be curious, let's take a peek at the top 5 equity funds with fee reductions as well, including their FTSE Developed Markets ETF, VEA, and their Dividend Appreciation ETF, VIG, which I know quite a few of you in our community own, and that we recently covered in some of our member videos, link below for reference. The expense ratio on VIG has gone down by 1 basis point to 0.05%, as you can see here. Also on the list are Vanguard's Information Technology ETF, VGT, their FTSE Emerging Markets ETF, VWO, and their Total International Stock ETF, VXUS. You can find the full list of funds with lower expense ratios on Vanguard's website. I've linked this nice PDF also in the first pinned comment for your convenience. The list also includes some tax-exempt municipal bond funds for California, New York, and Massachusetts. Now, let's talk about the highly popular Vanguard fund that I mentioned at the beginning that you can actually find cheaper elsewhere. Many of you own VOO, Vanguard's S&P 500 ETF. Vanguard did not lower the expense ratio on VOO this time around. So my general thinking about S&P 500 ETFs and funds is that they're more or less the same given that they track the performance of the same basket of 500 companies. That said, you should also know that VOO is the most expensive relative to SWPPX and FXAIX. SWPPX is Schwab's S&P 500 index fund, and FXAIX is Fidelity's 500 index fund. Vanguard's VOO charges an expense ratio of 3 basis points. Schwab's SWPPX charges an expense ratio of 2 basis points. And Fidelity's FXAIX charges an expense ratio of 1.5 basis points. This may not be much of a difference in absolute terms, but that's half of what VOO charges. And this lower cost is reflected in each fund's performance over a 1-year, 3-year, 5-year, and 10-year period, with FXAIX consistently performing a few basis points better than VOO and SWPPX. Now, as I said before, the difference is not huge. And personally, if I were a lifelong Vanguard customer, I'm not, but if I were, it probably would not be enough for me to switch over to Fidelity. But if you're an every basis point counts type of investor, this is something you might want to consider. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about treasuries and how to build a stable, predictable income stream in retirement, especially while bond yields are quite attractive, then check out this video here on our beginner and intermediate level bond courses. Or come join our next live member Q&A on Sunday, February 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be diving deeper into this month's 2, 5, and 7-year T-note auctions. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.